If you only looked at Africa's resources, you might assume it should be the wealthiest place on Earth. Oil, diamonds, cobalt, fertile land, you name it. Yet in 2025, many countries across the continent still sit at the bottom of global wealth charts. Even as the African Development Bank projects growth of around 4.3% this year, among the fastest in the world, hundreds of millions of Africans remain in extreme poverty. Economists often call this the resource curse, but the explanation goes deeper. We'll use an institutional framework, drawing on work by leading MIT researchers, to show why natural wealth alone doesn't translate into prosperity. Factors like extractive institutions, governance failures, and the unforgiving math of debt all shape outcomes. Understanding why this gap exists is the key to seeing the paradox that defines Africa's economy today. The paradox of plenty. This puzzle is often called the paradox of plenty. Africa holds some of the most valuable natural endowments in the world: oil basins, diamond mines, rare minerals critical for modern technology. Yet average incomes remain among the lowest anywhere. By conventional logic, such wealth should fuel broad prosperity. But the record shows the opposite. Resources bring windfalls, while ordinary people see little improvement in their daily lives. It's like standing in a massive orchard, but never controlling who picks or sells the fruit. You're surrounded by abundance, yet still go hungry. Economists describe this as the resource curse, and the mechanics are straightforward. A country strikes oil or discovers gold, and leaders promise transformation. At first, revenues surge and spending expands. Yet instead of building diverse economies, nations often become locked into one volatile source of income. When prices soar, governments splurge. When they collapse, budgets implode. It's reminiscent of a lottery winner who celebrates with cars and mansions, only to end up worse off because they forgot to plan. This dependence changes how governments and citizens interact. Resource rents become the state's main lifeline. Leaders no longer need broad tax systems to fund national spending, which means fewer demands for accountability. Without taxes binding citizens and state, transparency and representation weaken. Money still pours in, but it funnels upward, concentrating power and wealth rather than spreading it widely. That's how you get billion-dollar export sectors existing alongside schools without supplies or cities with high unemployment. There's also the volatility problem. Zambia's copper output, Nigeria's oil exports, or Ghana's reliance on gold all hinge on prices set in London or New York, outside their control. A downward price shock can undermine government budgets overnight, triggering cuts to social services or, in some cases, debt defaults. Foreign investors read this instability as risk, which discourages long-term capital. If you're a young professional in one of these economies, this isn't an abstract issue. Price swings determine whether jobs remain stable, whether savings hold value, and whether governments can commit to sustained investment. Many African economies lean heavily on just one or two raw exports. On paper, it looks strong when demand surges, but the moment global conditions shift, the entire economic structure shows its fragility. Contrast that with countries built on a broader mix: manufacturing, services, agriculture, tourism. And the difference is clear. Concentration creates vulnerability. And unlike industries that scale employment to large populations, extraction sites rarely hire broadly. Oil rigs and mines may generate vast revenue, but limited jobs. GDP numbers may rise, while unemployment barely budges and inequality worsens. Even when jobs do emerge, they are usually specialized, not spread across the general workforce. The result is a mismatch: impressive export receipts that don't filter down into greater opportunities for most households. This imbalance plays out across daily life. Teachers may see their wages tied to the oil market. Farmers may watch fertilizer costs spike when government budgets collapse, and families face an economy that lurches unpredictably rather than moving steadily upward. Corruption deepens the problem. Easy access to concentrated resource rents tempts governments to use revenues for political advantage rather than development. Oil, gas, or mining royalties can become tools to consolidate power, fund patronage networks, or divert into private accounts. Instead of schools and hospitals, money disappears into stalled projects or luxury living among elites. The idea of a curse feels less like a metaphor and more like the lived reality for ordinary citizens. Resource booms can also distort other industries through what economists call Dutch disease. When resource dollars flow in, the local currency strengthens. Manufacturing and farming products become uncompetitive abroad. Factories close, and other sectors lose ground. In Africa, where institutions often lack the strength to counterbalance those effects, governments slide into a dependency trap, stuck exporting raw commodities while broader development stalls. Yet resources don't seal a country's fate. Botswana provides a crucial counterexample. After gaining control of its diamond reserves, it built strong fiscal policies, directed income into public investment, and maintained relatively clean governance standards. Growth there shows that natural wealth doesn't automatically derail stability. Policy choices do. This contrast underlines the most important lesson. It's not the resource itself, but the institutions managing it that shape outcomes. The stakes are personal. Commodity volatility doesn't just appear in government spreadsheets. It controls whether jobs are secure, whether money saved today holds value tomorrow, and whether public services can survive downturns. For someone trying to plan a future, start a business, or even open a savings account, an economy tied tightly to oil or copper feels like building on shifting sand. Structural weakness bleeds into everyday uncertainty. Africa's paradox of plenty, therefore, isn't simply about economics. It's about systems that turn natural wealth into a cycle of fragility. Enormous reserves coexist with poverty because leadership structures, historical conditions, and global market exposure shape outcomes more than the resources themselves. Some countries have started to confront these traps, but most still find themselves vulnerable to the same boom and bust patterns. And those vulnerabilities have roots older than oil rigs or diamond mines. To see why so many African economies start from such fragile ground, we need to look at the way the states themselves were built, their borders, their political foundations, and the institutions designed to govern them. Borders that never made sense. Why do so many African borders run straight across deserts, forests, and mountains as if drafted with a ruler? A quick glance at a map shows it clearly. Countries like Chad, Mali, and Sudan carry lines that pay no attention to rivers, cultural regions, or communities. Unlike in Europe, where boundaries often reflected centuries of war, negotiation, or geography, most African borders were imposed during the colonial partition of the late 19th century. They were agreed upon in distant meeting rooms, not shaped by the people who actually lived on the land. This mattered because those lines divided societies that had shared languages, traditions, and trade routes for centuries. Families were split into different jurisdictions. Merchants who once moved freely across markets now faced barriers, tariffs, and checkpoints. Entire communities that saw themselves as one were forcibly separated, while groups with little shared history were bundled into a single political unit. The result: fractured states where national identity and economic integration are weak. Colonial powers had little interest in building states that could stand on their own. Their focus was resource extraction. Railways and ports were laid out not to connect towns with each other, but to funnel raw materials to the coast, ready for export overseas. Many rail lines and ports were built during colonial rule to move resources out, not to link local markets, so post-independence states inherited fragmented trade maps. Infrastructure bypassed inland economies, reinforcing disconnection between regions. Once independence movements succeeded in the mid-20th century, new African governments inherited these arbitrary borders and patchwork systems. Redrawing them was discouraged, partly to avoid sparking new conflicts, but also because the international community preferred stable maps. That left leaders governing territories without natural cohesion, forced to administer populations that often had deeper loyalty to local communities than to the abstract idea of a nation. This structural mismatch translated into fragility. Countries where one ethnic group dominated politics produced resentment among others, often leading to uprisings, coups, or separatist efforts. Governments struggling to maintain cohesion diverted scarce budgets into military and security spending, draining resources away from infrastructure or education. Potential foreign investors looked at these repeated internal conflicts and concluded that risk outweighed opportunity. In practice, weak national identity, coupled with inherited political borders, slowed both stability and development. There are exceptions. Some African states managed to cultivate stronger national unity across diverse groups, often through deliberate policy choices or by rallying around common experiences, such as liberation struggles. But many others remained shaped by divisions imposed more than a century ago. Instead of fostering inclusivity, governments frequently leaned on extractive approaches that concentrated resources in the hands of elites, a pattern that mirrored colonial rule. This reinforced inequality and made fragile states even weaker. The economic costs are visible. Borders that cut through historical trade networks disrupted commerce. In parts of West Africa, merchants who had exchanged goods for centuries suddenly faced customs posts and artificial constraints. It often became easier and more profitable to smuggle across borders than to trade legally. That eroded state revenues and allowed corruption to flourish within border enforcement. Over time, fragmented markets made it harder for African businesses to grow large enough to compete globally. Instead of one integrated regional economy, the continent is still divided into dozens of small and costly trade systems. The challenges extend to state capacity too. When colonial authorities built administrative systems, they designed them to extract wealth, not to create efficient governance or provide public services. After independence, these skeleton systems were passed on. Without traditions of accountability or strong bureaucratic culture, post-colonial governments struggled to arbitrate disputes fairly or manage the demands of such diverse populations. When communities felt excluded, their trust in the central government collapsed quickly. This dynamic explains why artificial borders so often overlap with weak institutions and fragile states today. Development projects in the modern era still collide with these mismatched borders. Building highways, bridges, or energy projects across multiple countries often sparks disputes over who funds what, which region benefits, or how revenues should be split. These obstacles stem directly from state boundaries that ignored trade routes and economic logic in the first place. Instead of cooperating on integrated networks, nations argue over dividing shares of limited projects. The legacy is not only material but psychological. For many, the nation's boundaries don't feel like something that represents them. Loyalty gravitates toward local groups, while the broader idea of citizenship remains abstract. In turn, politics is often interpreted less as a contest over ideas than as a zero-sum game between communities. Elections risk being seen as tribal competitions, where losing power means exclusion rather than policy change. That sense heightens the likelihood of conflict and undermines the stability that democratic institutions require. By 2025, the imprint of colonial boundaries remains obvious. Disputes over resources near borders still flare between countries. Within states, the divisions carved long ago continue to sap trust and limit cohesion. Leaders spend more energy trying to hold together fragmented societies than pushing forward sustained development. While the colonial borders may once have been drawn to simplify maps for European powers, today they complicate governance and weaken attempts at broad-based growth. These artificial lines did more than create awkward maps. They left behind weak national identities, distorted trade patterns, and administrative systems crafted for extraction rather than inclusion. And those legacies flow directly into the deeper problem: the design of institutions themselves, and how they shape who gains and who loses inside these states. Institutions that extract, not build. Why do some nations with little arable land or scarce resources manage to build wealth, while many parts of Africa with abundant assets remain poor? The difference often lies not in geography, but in the systems that shape how resources are used. Prosperity depends on the rules that determine who can participate, how fairly disputes are resolved, and whether investments are protected. When those frameworks are reliable, citizens and businesses take risks to innovate. When they are tilted toward a small elite, opportunities narrow, initiative stalls, and growth slows. Economists describe this as the divide between inclusive and extractive institutions. Inclusive systems create conditions where most people can contribute and benefit. Extractive systems concentrate wealth and authority in the hands of a few, often through mechanisms designed to preserve control rather than generate opportunity. This distinction is central to the research by Asemoglu and Robinson in Why Nations Fail, which we'll lean on here. Their studies found that institutions explain much more of the global income gap than geography or climate. If property rights and fair rules are secure, innovation is rewarded. If they are not, development falters. A clear way to picture the difference is through a game analogy. Imagine Monopoly played under two sets of rules. In the first, everyone follows the same standards from start to finish, so long-term planning is possible. In the second, one player changes the rules at will, seizing properties or exempting themselves from rent. Under that system, no one else has an incentive to. Invest because gains can be stripped away. Growth accrues only to the rule maker. Economies with extractive institutions work much the same way. By contrast, Botswana structured its diamond revenues under relatively inclusive rules, strong contracts, predictable reinvestment, and mechanisms to limit elite capture. The result was steady, long-term growth, proving that resources can build prosperity when institutions support fairness. The historical roots of Africa's extractive systems lie in colonialism. European administrations built courts, taxes, and bureaucratic offices to facilitate extraction rather than foster competition or protect rights. Railways and ports, as noted earlier, were engineered to funnel exports abroad rather than integrate local economies. When independence arrived, new governments often retained these extractive blueprints. Leaders who inherited power had little incentive to dismantle them. Instead, many stepped into the role of gatekeepers, maintaining structures that concentrated wealth. These legacies hardened over time, leaving citizens in systems where building anything new was risky, while securing favors from elites seemed safer. The everyday consequences are visible throughout the continent. Farmers hesitate to shift into higher-value crops when they worry about unfair government pricing boards. Skilled entrepreneurs limit their ambitions when they doubt contracts will be enforced in court. Banks allocate loans based on connections rather than sound business plans. Under these conditions, talent is either wasted or exported. The economy cannot capture the energy of its workforce because the rules penalize initiative and channel rewards narrowly upward. Extractive rules also erode trust. To run a business in such environments, participants must add layers of protection, side payments, personal guarantees, informal networks, before taking any risk. These costs slow down growth projects and disincentivize new entrants. In turn, the absence of trust increases the cost of governance as well. Without faith in fairness, citizens resist paying taxes or obeying regulations, assuming they mainly enrich those at the top. Governments then struggle to mobilize resources internally, pushing them toward external borrowing or heavy reliance on volatile resource rents. Inclusive systems flip those dynamics. Secure property rights assure farmers that their harvest belongs to them at market prices. Independent courts signal that contracts stand a chance of being honored. Transparent public budgets show where tax money is spent, giving citizens a reason to comply. These features make ordinary people more likely to start businesses, invest savings, or seek credit. They connect institutional design directly to personal finance and jobs. The more rules reduce uncertainty, the more individuals feel safe betting on their own future. This explains why resource scarcity alone is not a barrier. Countries with limited natural wealth but stronger institutions, such as well-enforced property rights or impartial courts, develop industries to create value beyond what the land provides. By contrast, countries with fertile land and rich mines but extractive rules fail to translate assets into sustained broad-based wealth. Leading research argues institutions explain much more of this difference than geography or climate ever could. That doesn't mean extractive systems are permanent. History shows they can evolve. Over time, citizen pressure combined with external incentives can push governments toward accountability. The transition is rarely easy. Entrenched elites resist losing privileges. But when reform takes hold, the results are dramatic. Investment capital arrives, entrepreneurs return or stay, and growth spreads beyond resource pits. Inclusive transitions turn youthful populations into an advantage rather than a liability, creating labor forces ready to fuel new industries. Africa's challenge remains bridging that transition. Establishing credible reforms requires both leadership restraint and citizen confidence. Cosmetic changes, laws that remain unenforced or oversight bodies without authority, do little to shift behavior. But when signals are clear that rules apply broadly and consistently, trust accumulates. International partners also play a role. Rewarding long-term accountability rather than short-term export volume matters to sustaining reform momentum. Still, examples from across the continent highlight how difficult this balance has been to achieve. Countries experiment with stronger frameworks only to see them undermined by old patterns, opaque budgets, politically captured courts, or discretionary licensing. Others sustain progress for decades, but remain vulnerable to swings in global prices or external shocks, testing the resilience of their institutions. By 2025, the gap remains visible. Some states manage relative stability through stronger institutions, while many others remain locked in. Elite-driven cycles. Behind these patterns is a larger dynamic. When rules are extractive, trust erodes. And once trust erodes, people inside and outside the country view the entire system as unreliable. That perception matters as much as the reality, because it shapes whether investors, partners, and citizens believe growth is possible under current governance. And that brings us to another layer of the problem: how weak governance generates barriers that extend beyond domestic politics. The issue is not just money siphoned away by elites, it's what those practices signal to the rest of the world, and how damaging those signals can be. Governance and the reputation problem. Governance and the reputation problem operate as silent but powerful brakes on Africa's economic potential. Corruption is not just a matter of stolen funds or vanished contracts. What makes it deeply damaging is how it shapes expectations, both inside and outside a country. The more unpredictable governments appear, the higher the risks assigned to doing business there. This reputation effect magnifies far beyond the missing money itself, and often locks entire regions into slower growth. Many people picture corruption as a politician pocketing bribes, and sometimes that's accurate. But the broader issue is how each incident broadcasts instability. Every diverted dollar weakens not only public services, but also signals to investors and citizens that rules are negotiable. In practice, this works like a hidden tax, not added formally through law, but imposed through uncertainty. Businesses factor that tax into decisions, sometimes by raising costs, sometimes by walking away entirely. For foreign investors, the signal of corruption frequently outweighs the underlying economics. On paper, a large oil field in Nigeria or a natural gas basin in Mozambique might look enticing. But news about frozen projects, contested contracts, or sudden regulatory shifts reshapes the calculation. Investors start attaching higher risk premiums because they cannot be certain what new government, court decision, or informal power arrangement will mean for their money. As seen recently, geopolitically unstable projects, like the stalled Niger pipeline, can halt investment and derail expected returns overnight. And in today's financial environment, high global interest rates make investors especially cautious. Safer assets elsewhere promise solid returns without political risk, so Africa's riskier opportunities are often skipped over. These external judgments have serious internal consequences. Countries battling corruption find their borrowing costs climb steeply. International lenders fold the risk into higher interest rates, which pushes governments to spend more of their limited revenue servicing debt instead of investing in schools, infrastructure, or healthcare. This siphon widens the gap between what's needed for growth and the money actually available. For citizens, this trickles down into daily life. If you're starting a business or trying to access credit, reputational risk makes banks more reluctant to lend and interest costs higher. That limits opportunity before a venture even begins. Citizens also feel the problem in how they perceive their own governments. Teachers who see their school budgets drained upward lose motivation. Nurses working in underfunded clinics develop a habit of survival through informal methods rather than relying on state support. Public sector morale erodes, and cutting corners becomes normalized. Institutions stop being spaces of service and instead turn into arenas of negotiation, favor trading, or delay. In this way, corruption entrenches itself not just as theft, but as everyday practice, deepening mistrust. The impact is clearest when tied to failed projects. Imagine a major highway project intended to connect a coastal capital with an inland trade hub. Local businesses and farms prepare for reduced transport costs and new access to markets. But halfway through, the project stalls because funds vanish, irregularities plague contracts, or lenders suspend disbursements. Communities end up with half-finished work, rusting equipment, and rising cynicism. Businesses retreat, farmers struggle to repay debts taken on in optimism, and families lose confidence in government promises. When stories like this circulate internationally, the reputational damage multiplies. Investors abroad rarely parse the details of each situation. Instead, they see a pattern: projects collapsing, contracts contested, rules shifting, signs that the environment is risky and unreliable. This can blur very different national realities together. In practice, all 54 African economies risk being perceived as one undifferentiated high-risk zone. Reputational spillover means that even governments working seriously on reform still face elevated costs, simply because of regional association. The reputational penalty isn't quick to fade. A corrupt official might be removed or a new law passed, but lenders and companies look for consistency over years, not isolated signals. This stickiness slows recovery. Countries that improve governance often wait far longer than expected before investor behavior changes. In the meantime, progress feels muted because structural reforms don't translate immediately into lower borrowing costs or higher capital inflows. For leaders trying to attract private finance, this long lag frustrates both planners and the public. The costs also extend across borders. Some leaders present corruption as an internal issue, but the interconnectedness of African economies means one country's governance can disrupt regional hopes.